All right, so today on the Business Ideas Podcast, every Friday, Peter and I, we want to take a business that's already existing. So this isn't a new idea that we're sharing with you, but the idea is that Peter and I will share our experience of businesses that are in the wild, that have revenue, that are willing to share their numbers on sites like WeFunder, Republic. What are some of the other sites?
Seed Invest, there's a bunch out there. So our goal is to look at a bunch of these different sites every week and find a company that we think is interesting, that has an interesting business idea, and give you our thoughts on the business idea, the market, the competition, the strategy, almost as though, we were looking at making an investment in the company ourselves. We won't provide any investment advice. That's not really the goal of this podcast, but really we want to kind of share our thoughts about the company, the business idea, and just kind of our perspective in terms of how we think about these businesses, right? Either from the investment perspective, which is kind of my seat, or from building a business, which is more John's seat.
Yeah, and the point is that if you begin with the end in mind, and if you can learn ideas, and then if you can also see what ideas might become, you can get an idea of what would be a good fit for your personality. Like some people are looking for more lifestyle businesses. Some people want to go for the fence. Maybe you want to start the next Google, or maybe you're looking just to make $2,000 to $4,000 on the side every month. And so we are going to share those ideas. So Fancy.com is a business model, WeFunder. So if you go to WeFunder.com/fancy, they are in the current process of raising $1 million through a crowd equity funding deal. And we want to make clear we are not soliciting stocks or sales. We are not associated with WeFunder at all. The point is to take an academic dive into a business model, and they've publicly shared their information with us. You started. So what is Fancy?
Yeah, so the reason we picked Fancy is because years ago it was a product I actually used. I remember when they first launched back in 2009, 2010. I was a customer, not really a customer, but a user of the platform. And what they do is it's a very curated, they curate, but they also have crowd curated products that are all just super interesting and very unique. And the idea is that you can kind of scroll through and find all kinds of really interesting products that are hard to find otherwise. And you can buy these products. And you can follow different people, and people will post different things that they think are interesting. And it's everything from home decor to different clothing, different gadgets, all kinds of stuff like that. And it's all, super unique and really, really cool stuff.
First of all, let's look at your approach, Peter. As an investor, what has your background taught you about this business?
Yeah, so when I'm thinking about a business like this, what I really want to see on a business like this is really, really high engagement. So when I think about other investments that we've made as a firm, we're investors in Pinterest, we're investors in Poshmark. Both of those, there's a very much like an entertainment aspect of this that keeps drawing people back, right? You want to see people coming back to the platform and then spending a lot of time on the platform on an ongoing basis, that it almost has that kind of addictive type behavior. So that's one thing that I think is really important for businesses like this. Kind of corresponding to that, you'd want to see a business, especially hopefully something that has some network effects like this, to have a little bit of a viral component. So customer acquisition cost should be a little bit lower because your current users should be kind of promoting and sharing and drawing people in as well. So that's one thing I'd want to see. In this particular case, this is a marketplace. And so
I love marketplaces, by the way.
Why do you love marketplaces?
So I like marketplaces because you create a place where others are contributing and creating more value with you. The point of a marketplace, they're tricky, and I've tried doing one before. It's hard because you create a platform, and so in this case, people are selling their artisan products here on the site, and then you've got buyers. And so all you're trying to do is create a bigger brand in a sense. And with every additional person listing their artisan products on the site, your site becomes worth more.
Yeah, no, certainly. There's nothing more defensible at the end of the day, in my opinion, than a dual-sided marketplace with strong network effects. Because, just like Uber is the prominent ride-sharing platform today because they have so many cars on the road, when I open up the app and call an Uber, I know I'm going to get one very quickly. and the drivers know that there are tons of passengers on there, right? It's really hard for a new company to come in and encroach on that market. Right?
It's almost like a monopoly. Is that how you would look at it?
No, totally. I mean, and that's ultimately what you're looking for in a startup. You want to look for companies that are creating some sort of monopolistic power, frankly. And marketplaces and network effects can really do that. Yeah, I mean, you want to look at the strength of the network here, and that's going to be a measure, like I said earlier, of how much time and engagement you're getting from your users on a platform like this, right? Because that's going to feed into the number of companies that are actually listing products on the space. If they feel like there are a lot of people on the space, they're spending a lot of time here, they're buying things, that's going to attract more businesses. And more businesses that come on the platform, particularly the ones that have really compelling products, are in turn going to bring more users over and also more highly engage them. So this is kind of like pulling in both pieces, and as both pieces grow, they grow up together over time.
Have you invested in a marketplace before, Peter?
Yeah, I mean, a lot of what we do at University Growth Fund is invest in marketplaces. So we were investors in Lyft, we're investors in Postmates, we're investors in Pinterest, we're investors in Poshmark. Again, we really like the model because it does create those barriers to entry.
So what do you like? What would be like the 3 highlights of what you think Fancy would be a good idea from a marketplace, and what would be 3 negatives, perhaps?
Yeah, so 3 things that I like about Fancy. So 1, I think they do an exceptional job at identifying very, very unique product. The other thing I really like about Fancy is they've got like an incredible brand that they've built over the last decade almost here. And, you know, a lot of people kind of known it. They've had over 12 million subscribers or users set up accounts. And then, you know, look, I really like the engagement from some of their influencers, right? They've got people like Drake that's on there and uses the app and tells people about it. And they have a total of like 4,000 VIP users that are, you know, highly engaged in curating content and posting new content. And I think that becomes like a really strong competitive advantage for them, especially when it comes to adding content. Some things that make me really worried about this is they basically have 3 types of revenue. But the biggest driver of this is they want to take a cut, up to a 40% cut of all transactions of the platform.
I mean, the general rule is if I make a product for $2.50, I would sell it to a wholesaler for $5 or to a store, and then that store would then sell it for 10 to 20 in order for each part of the supply chain to be profitable to sell.
Right.
So in this case, you know, you're basically going direct to consumer. You don't have all the brick and mortar, and Fancy is doing a lot of advertising for you. eBay's only like 10%.
Yeah, eBay's 10%. Poshmark, I think, is around 20%. I mean, it just feels a little bit high to me.
Yeah.
And so one of my big concerns going through this is Fancy's whole pitch here is like, look, this company's been around a long time. In the early days, you know, they launched basically 2 months before Pinterest did. They raised about 4 times as much in that first seed round.
Fancy's raised a total of $124.4 million.
Yeah, I mean, they've raised a lot, and they've had some amazing backers like General Catalyst and others, Allen and Company. I mean, just really great backers. Company grew super fast, and I think ultimately it was this bet on like, is the Pinterest model going to work, or is it going to be more highly curated solution like a Fancy? And I think what the market really determined is that Pinterest was the right model there to really win. And so, you know, now you've got a business that's done a complete restart. You know, they're trying to grow sustainably, which I think makes a lot of sense and is very commendable. My concern, though, is if the business model only really works at scale, can you do that in a way that you grow, quote unquote, sustainably or not? Because you've got to get users, you got to get them engaged, you got to reach that scale so that even though you're collecting a small part of every dollar that's transacted on your website, you get so many of those transactions you can actually make it work, and you have a nice set fixed cost. And I think that's something that Fancy hasn't been able to prove in the past when they raised a lot of money. And I don't know that there's enough information here to get a lot of comfort that they can get there on the current model either.
Yeah, and I don't know if they've got at the core if they actually have a competitive advantage. Like if I'm an artisan and I'm selling special lamp hats, like lamps that have hats on top. Like I could list that still on Amazon if I want. I could sell it on eBay. I could sell it on Etsy. And so at the end of the day, from what I see in their current model, if you were trying to start this business today, I have a hard time seeing any true defensible model other than, hey, we're fancy.com and you know we specialize in a certain product. But at the end of the day, you could just follow 20 influencers on Pinterest that you like and get all the same value. So the switching cost is super easy.
Yeah, potentially, right? Their thesis is we've got this great brand, we've done all these things in the past, we get to leverage all of this, and you get to invest in a really low valuation relative to what it costs us to build all of this. And the other piece that they're really pushing is this idea of today, if you are a boutique brand, artisan brand, whatever it might be, it is really expensive to sell your product through the major channels, whether that's Facebook, Twitter, Google, and so forth, right? Because those platforms are so powerful and they know it, that they can charge very, very high advertising costs. And so it makes it really difficult for a small company to advertise on Facebook, pay those high Facebook advertising fees, and still generate a profit once that traffic converts into sales. And what Fancy is saying is like, look, we can basically undercut the Facebooks of the world and provide this more economical, efficient advertising platform for these artisan sellers. I think there might be some validity to that. What it is implicitly saying, though, in a way, is that they're leaving some money on the table. And I think the other part is then you have to really build a very robust platform that makes it really seamless and easy for people to buy products through it. Which I think, to their point, to their credit, they've built a pretty solid platform in that regard.
What are your thoughts on a marketplace versus a social marketplace? Because Amazon is much more of a marketplace as opposed to having a strong social component, from my perspective, compared to what Fancy is pitching.
Right. Well, again, and that's why I said at the very beginning, it's important how much time people are actually spending on Fancy. So a social network, right, or a social marketplace, what you want is people that are highly engaged because it's got that entertainment factor, right? That eventually turns into transactions. I don't go onto Amazon for an entertainment, really, right? Like I know what I want to buy, I go on, I buy it. I might look at like some reviews, right? But I'm not searching for new product. And that's an area where they are definitely different. On the flip side, if I go to Poshmark, there are people that spend hours a day on Poshmark. And for them, they're checking, they follow a bunch of different people that curate different things and that put together different style packages and so on and so forth. And for them, it's as much fun just to be searching around, looking at different products, as it is actually buying something, right? And so I think that's a critical part of what Fancy really needs to do well.
As we were preparing for this episode, what are some of the main points you wanted to address in this podcast?
Okay, so here's the deal with this particular investment, right? Is that you have a company that grew really quickly, raised a ton of money. The business model fundamentally didn't work because they had to burn too much money to acquire users, and those users were not converting into buying customers at the end of the day at a fast enough rate to cover the fixed costs of the business. That's the only explanation that really makes sense for this business, right? If you think about it. And so they were burning so much money that eventually investors came in and said, we're not going to put any more money in. They had to do a massive down round. The company went from a valuation of $600 million down to a valuation, I think, of like $1.5 million. So just basically a complete restart. And you had investors that came in and said, okay, look, Fancy's built this incredible business model. They've got millions of dollars in revenue. They've got great technology, great team. If priced right, can we still generate a great return on this investment? And that's the idea behind the restart. They raised a few $1 million to be able to kind of right the ship, if you will, swapped out management team, so on and so forth. And today, they've come back to the market to raise an additional $1 million on WeFunder, which they say will be matched by an additional $1 million from one of their venture funds. And so you're investing in a company in a convertible note at a $12 million cap, which basically the way to think about that is that's kind of the value of the business today is $12 million. The company did a little over $5 million last year. So, in general terms, you're paying a little over 2 times revenue. But they also burned almost $5 million last year. So pretty healthy burn. They basically have burned most of the capital that they raised in that prior round to kind of turn things around.
And they were at a 23% drop in revenue from 2018 to 2019.
And that's the other thing, is that revenue dropped from $6.6 million to $5 million. And it's not particularly clear that they're, based on the materials they provided, that they're going to be able to rebound up to $13 million, which is what they're projecting to do this year, particularly as they cut expenses related to driving additional users to the platform, right?
One of the things that they talk about, and I think this is probably a mistake that a lot of founders make, is they had their initial, social marketplace, but then they started doing brick and mortar. Then they started selling their enterprise software to other companies, and pretty soon they lost track of what perhaps was their core business model, or perhaps they were trying to search for a better business model and then created several business units that were not profitable.
I 100% agree, right? It's clear that to some degree they were searching for a business model that worked. And frankly, like this is what Pinterest did as well, right? Mm-hmm. So Pinterest started, they didn't even start generating revenue for years, right? And same with Facebook. And that was the whole idea is like, look, we're going to build this community, this social network, if you will, of users. As we get them highly engaged, then we'll start trying to figure out how to monetize them. And so it looks like they kind of threw lots of stuff up against the wall and none of it really hit. Personally, I would love to see a lot more data around why the 3 revenue channels that they've set up and are focusing on today, they believe will work. And unfortunately, not a lot of information in their deck or materials around why that's the case. But it's marketplace, right? Which we talked about. You got to get scale for marketplace to work. You got to get lots of users, and you got to get them in a platform that convinces them to buy and transact on a frequent basis. The next thing in their business model is they have this white labeled technology where they'll sell their actual technology to other players, which concerns me in a few ways. One, if I am a company where a social network or social marketplace is really important, I think that's something I probably want to own myself. I probably don't want to buy that off shelf. It also, though, sets up the potential for competitors, right? I'm going to come in and I'm going to use this thing that Fancy is touting as like this really great technology that creates a real barrier to entry for other competitors, but then I can just buy it from Fancy for like a few $100,000 a year and set up a very competing site.
Or the other problem is if you do build your model on enterprise software and you sell it to companies. So for example, Mint.com, that might be kind of too old of a company, but Yodlee was the engine that backed it. Eventually, a new company came in and bought it, and they rebuilt the entire back end. And so you spend all this time building and growing with a customer to find out that you lose them. And so you don't, other than just trying to be the most amazing and do it better than someone else can, you have no long-term competitive advantage if someone takes off.
It's kind of the worst of both worlds, right? Because on the one hand, you want a customer that comes in, they never really grow, but they don't go out of business. That's your ideal customer.
1 million mediocre customers.
But if they come in and they crush it and they're amazing, they're going to displace you, right? They're going to build it themselves and get rid of you.
Like what Intuit did with Mint.
But they're more likely to just go out of business, right? Because they don't have the commitment to build it themselves.
And you have to find the next one. So super tricky.
And you're running enterprise sales on top of trying to build a marketplace. And in my experience, it's really hard for a startup or any company to do more than one thing really well. The companies that do more than one thing really well are companies like Microsoft, right? They do like Windows and they do Office and now they do Azure, right? Or you've got like companies like Apple, right? It's like iPhone and computers, right?
So part of their pitch is for this is they are going to focus back on their initial core model being a marketplace and drop brick and mortar and drop enterprise software. And I think
but they're still doing it, right? So this white label technology is still what
they claim they're dropping in their Q&A.
They're dropping the unprofitable units, but they don't actually declare what it is.
Which means they're also not focusing yet again.
Right. And then they have this media solutions, which is like basically an agency, right? They've got a lot of different things,
So it sounds like they're only dropping the brick and mortar, which brick and mortar is tough.
Yeah, and they probably should have dropped that. They probably should have never gone into brick and mortar, frankly.
It sounds like that's the only thing they're dropping of the 4 models they're looking at. So I don't know how 1 million plus 1 million from someone else solves that problem.
Right.
You need like 10 plus million just to reboot it, to do all of it.
Probably. Especially because when you consider like you just need scale at the end of the day, right?
Mm-hmm.
I think, look, the parallel to this is another company called Wish, which I think is a phenomenal business and really interesting. So what Wish does is very similar to this. The only difference is that instead of working with artisan manufacturers and businesses, they work with companies out of China. right? So these Chinese companies, they come up with their own products, or they'll find other products in the US and make ones that are similar to them, and then they sell them on Wish at a massive discount. And it also takes forever because they put these things on a boat to ship them to you, so it can take like a month or two. But you can go in and you can buy like a new pair of shoes for like $3, right? That look really cool, and they probably only last like a week, but they only cost you $3, right? And it has a very high entertainment factor, right? Because there's so many, like thousands and thousands and thousands of unique and cool products that you can go on, and everything is impulse purchase territory. And I think that's one of the big challenges that Fancy has, is that they are going after this luxury side of the market, which is not really an impulse type market, right? It's like, you want to buy a chess set, that chess set's $300, right?
Yeah.
You want to buy that like that really cool glass for drinking your scotch, that's $50, right? It's not really impulse territory. And some of the products are like tens of thousands of dollars on the site. And so
And you're going to go shop elsewhere.
you're going to shop elsewhere, or like, look, I'm
Go direct.
going to curate this huge list of things that I think are really cool. I'm probably not going to ever pull the trigger on one. Right? Because I'm not going to drop $300 on a chess set unless I've like seen it in person, right?
Right. I think one of the things that when I look at Fancy is, I've always been told, this might be right or wrong, is that if you're going to try to displace a market, you have to be 10 times better. So if you look at a market that's being displaced, it's eBay. And eBay, in my mind, is another kind of a social marketplace, and it's getting displaced right now by OfferUp. The simple thought was, hey, I'm going to get an item, take photos, I then have to upload or transfer those photos to my computer, and then I have to go and create, list it on the site. Where OfferUp, their core differentiating factor was just do everything straight from mobile, and for some reason, the executives at eBay didn't understand that. But that alone allowed them to creep in and become 10 times better, and the larger companies couldn't pivot. Where with Fancy, I don't sense anything like that in their model. At the end of the day, I just see them as curated goods that I could say, hey, who is this person? Where else are they selling?
Yeah.
Where's the best price?
Well, and something you had mentioned earlier, right, is like, why would I go to Fancy when I can just go to Pinterest and I can follow people that are already going to curate this for me? It's a similar experience, but Pinterest already has the users, and their cost to acquire a new user is so low, and they don't even need to monetize like those products that are listed on there, because they have this whole advertising model where, Home Depot is more than happy to pay really high advertising, to drive users.
Can we talk about their technology?
Sure. What do you think
I
of their
think
technology?
this is
You're the product
garbage.
guy.
This is garbage. So here in 2020, I believe that companies compete either by, the innovator's dilemma, right? Where eBay, they had their website, they don't want to cannibalize their traffic, they don't want to they don't want to retrain all their users, or you build a really strong brand. Because I could go and build something like Fancy, probably like not all their seller tools and a fancy storefront, but like I could build something comparable probably in 2 to 3 months.
Yeah.
And it's going to cost 10, 20, 30 grand max, depending on what you want it to look like. At the end of the day, their technology allows them to scale, but it's, to me, if you look at their traffic on sites like SimilarWeb, they don't have that brand. They don't have the stickiness.
That's fair. Yeah, I mean, they really claim it as a core competitive advantage. But there's nothing there that, based on my experience, where I've said, wow, like that's a super differentiator. I feel like it was 5 years ago,
yeah.
but not.
It's
not
not like
anymore.
TikTok, where you can be on the platform within 30 seconds to 2 minutes, and they are honed in on your personality, where that might make something slightly more interesting here.
Look, I think, on the positive side, as we wrap up, you're buying in at the company at like a $12 million valuation. And look, if they can actually hit $13 million in revenue and not burn all of the money so they still have money to keep growing, like, I think this could be like an interesting investment from a perspective of like, look, you're buying in at a really low valuation. If they can hit the financial metrics that they've put out, then, maybe this ends up generating an okay return.
And I hope Greg and Nora just crush it.
For sure. Yeah, and I think they've got a good team put in place, and it sounds like they're doing all the right things, right? Really cutting burn, focusing on the business units that really make sense, making this a very attractive option for artisan sellers and other type companies where they can sell at a much more efficient marketing spend. I think a lot of those things make a lot of sense. I think as a venture capitalist, if I'm, swinging for the fences, right, like on these deals, this one might be a little more tricky to get in to do, right? Because you're looking for this thing to become like the next Pinterest. And I don't think that that's in the cards for this company. But the flip side is I think they can continue to kind of grow an interesting business.
Mm-hmm. Yeah, so we'll be keeping track of Fancy over the coming months, and we'll see what happens. And it might be an interesting model to come back and compare and analyze. And so, if you are looking to start a model similar to Fancy, we hope that Peter's perspective as a venture capitalist and mine as like a founder operator, this has given you some perspective as you evaluate what businesses you want to start or continue with in the future.
Awesome. Well, thanks for joining us. We look forward to seeing you next week.
All right. See you guys next week. Thanks, guys.